Hello and welcome to ETF Pulse, ETF.com's newest podcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com, here as always with my co-host, Nate Geraci, president of the ETF store. Now, before we begin, if you haven't already, please make sure to hit that subscribe, like, or follow button so you can keep up with us each and every week. Now, every Wednesday, we're going to be here to discuss all the latest in the world of ETFs. Now, taking a look at the Pulse rundown. First, SPY is not going quietly into the good night. Can the unseated king of ETFs take back its throne from VOO? We're going to be chatting that first. And investors are piling into gold as traders seek a safe haven asset. GLD saw the largest inflows in the past year. And while gold is shining, I had to give a little pun. The same cannot be said for Bitcoin. Bitcoin ETFs saw the largest outflows since Friday, led by FBTC as Bitcoin prices fall. And we're going to continue the conversation with Bitcoin as investors wanting to buy Bitcoin and Ethereum inside of one ETF wrapper are going to be able to do both. And last up, we'll be chatting Fidelity and their new suite of model portfolios. I'm so excited for today's talk, mainly for that Bitcoin conversation, Nate, because I know what a Bitcoin bull you are. But thanks so much for joining me, as always.
Always a pleasure to be here. Did you think I like talking Bitcoin? Where would you get that idea?
I know. I have no idea. It just a little bit of like a psychic ability, I think, really has that going. So let's talk VOO and SPY, because last week we were talking about this, essentially VOO surpassing SPY as the world's largest ETF. SPY has now reclaimed its crown. We obviously have to see what today's trading session brings. We did have massive inflows into SPY. I decided to pull up the ETF Pulse chart. It brought in over $5 billion in inflows last week compared to only 2.5 for VOO. So what do you think of this defense, if we can call it that SPY is essentially mounting to protect its crown as the largest ETF? I don't think they're going to be able to hold on to it for very long. I bet by tomorrow we'll already see that VOO is back on top.
You know what I'm calling this entire thing? I have a name for this. It's ETF Game of Thrones.
It's so corny.
Well, yeah, the question is, did we jump the gun last week by celebrating VOO overtaking SPY, right? Because we made this huge production about VOO finally claiming the ETF crown. We popped the champagne maybe a little bit earlier. I think that longer term, there's no question VOO is going to run away from SPY. But in the short term, there might be some back and forth between the two, because SPY, as we discussed, is much more of an institutional trading vehicle. And you get a lot of hot money flowing in and out of it. And here recently, the markets have been much more volatile. And I think when you have more volatile markets, you're going to see traders and institutional investors move in and out of SPY. And so you're going to get some volatility around flows. But longer term, I just don't see SPY keeping up with VOO. And like I mentioned last week, I wouldn't count out the iShares Core S&P 500 ETF, ticker IVV, either. I think that'll pass SPY. Now, can it catch VOO? I don't know. The way I think about these is that VOO is really long-term buy and hold money. SPY, as I mentioned, is much more institutional, hotter money. And IVV, I think, sits somewhere in between. But did we pop the champagne a little bit early? Perhaps, but we know how this is going to turn out longer term.
I don't know well, first of all, I didn't pop champagne at all. And if you did, I'm a little bit upset by that because I was not invited to that party. But no, I agree. And a lot of people have asked, really, what's the difference between SPY and VOO? And of course, there's just the pure expense ratios. SPY is so much more expensive than VOO is. And so to your point, if you're just a regular retail investor that's just buying it to hold for the long term, VOO probably makes more sense. Or even looking over at SPY's cheaper counterpart, which is SPLG. That is also another a fund that you can kind of look at. IVV, also very low cost. I think what now the question is going to be more than what's going to happen between VOO and SPY, because as you're mentioning, SPY has higher trading volume. It's a better trading vehicle for the shorter term duration. I think I want to know what's going to happen between VOO versus IVV versus SPLG. If we're going to start to see a sort of race to the bottom when it comes to the fees in these sort of broad market funds, now that I think that there has been such an upswell in interest and renewed interest and kind of as these retail investors decide, hey, I actually probably should just be putting my money in VOO, because I mean, the markets did incredibly well in 2024. If you just put all your money in VOO or SPY or IVV, or SPLG, I mean, your portfolio would be up nearly 30% and you had to do no work for it. So do you think that there will be we'll start to see the dropping of the fees? I know SPY can't. I mean, they're very limited in what they can do because of the way that that fund is structured, but the same is not true for some of its cheaper competitors, right? Do you think that we're going to start to see some of those other funds drop those fees to really start to go after VOO in a more competitive way to kind of attract those retail dollars?
Well, the thing is, there's really not much further for those ETFs to drop, right? SPLG's at 2 basis points.
Yeah.
Yeah, VOO and IVV are at 3 basis points. I do expect at some point for IVV or VOO to chop fees to match SPLG. I think VOO will naturally get there over time because of the way Vanguard operates, where the funds are essentially owned by, or the company's essentially owned by the shareholders. Over time, as assets grow in their products and they have those economies of scale, any cost savings are ultimately passed along to investors. So I think it's just a matter of time before VOO gets down to 2 basis points. Does IVV proactively reduce fees? Yeah, I can see that for sure.
All right, well, moving on, because I know we're going to be talking about this again, but let's talk about gold because we have seen really large inflows. And I was just checking out the inflows for over this past year. GLD in particular has had the most inflows as of Friday as it has in the past year. Really high numbers. We literally saw they hit 3.8 billion in inflows in just this past week. The spot price for gold right now is up over 2,900, which is kind of like the level I feel like it's been hovering at recently. The gold story is interesting to me because I feel like people have been typically, right, gold is a safe haven asset. People tend to flock there when there's sort of chaos or sort of uncertainty in the economy and the markets. And we do have news, I think, that would cause people to kind of have a little bit of trepidation, right? We had tariffs, we have, these news of layoffs that obviously make people concerned about future unemployment numbers. Stagflation is coming back up again. So I can understand why people are piling into gold, but people have been piling into gold as they've also been piling into equities, which usually I feel like people tend to do one or the other. So what do you see as gold? How do you see gold really kind of playing in people's portfolios, or really how should they be thinking about gold in their portfolios at a time when, of course, right now we have a little bit of market volatility, but at a time when we do have markets on the upswing?
So everything you said there was entirely accurate, but let me add just a little bit of context. So with GLD, I just want to be clear, it had its largest daily inflow ever this past Friday. That was at 1.9 billion. And then, as you mentioned, last week was its best week of inflows ever. And what's interesting about that is Monday was a holiday. So we're only talking about 4 days of trading. It posted nearly 4 billion in inflows. Here's what's interesting to me about gold, and I've talked about this before. It has actually been performing very well for a while. If you look at the trailing 3 years of performance, GLD is actually outperforming the S&P 500. But for whatever reason, actually up until fairly recently, certainly goes back into last year, but ETF investors were not buying physical gold ETFs the way you would expect. So I looked this morning, even after the strong start to this year, so with the record flows I just mentioned last week, gold ETFs actually have close to $6 billion in outflows over the past 3 years. And again, that's the same time where gold has outperformed the S&P 500. Typically, you don't see that in the ETF space. Typically, when you have a segment of the market performing really well, you'll see flows follow. But that hasn't been the case, right? This has been one of the more perplexing stories in the ETF space that I've seen in a long time.
Yeah.
And, in terms of the investment rationale for gold, and I'll come back to the flows in a minute, I always say that gold marches to the beat of its own drummer. And you don't really know what you're going to get out of gold at any point in time. But I think that this is an uncertainty play right now. I think in large part tied to the uncertainty around how President Trump will handle areas like trade and immigration and geopolitical issues out there, like with Ukraine. Investors are unsure how all this will play out. And I think gold is viewed as an uncertainty hedge. It's a safe haven. So I think right now investors like the idea of owning gold as a hedge when they're lacking confidence in other areas of the market.
Costco. Odd that we'd be having a Costco conversation at the same time as we're talking about gold ETFs. But Costco, this is not an equity show. but as a company saw revenue massively skyrocket just by people purchasing gold bars from Costco, which what a time to be alive. And now obviously, yeah, as you were mentioning GLD, I mean, I have the numbers 1 year to date, GLD is up about 12.5%, but for the 1 year up just under 45%. So yeah, as you're mentioning, massively beating the broad market, but why then are people running out of this store?
Well, you're saying running out of the ETFs, or
no.
Why is Costco selling out?
No. Sorry, not out of the Costco store, but out of the proverbial store with GLD in it. I mean, why are flows not following the performance?
And so I think that's the interesting part of the puzzle that I think we're now finding the pieces to, because we are seeing those massive inflows into gold. And I wonder if there's a lot of pent-up demand there, where people, even though gold was performing really well, we weren't seeing the flows, and now gold is on everyone's radar. And so we're seeing outsized flows. It's almost like a catch up to what we had seen over, the past 3 years or whatever I mentioned. So the other factor here, just real quick, I know we're going to talk Bitcoin ETFs. I've heard some people theorize that the debut of spot Bitcoin ETFs last January and the record inflows we saw into that category, maybe that siphoned some demand away from the physical gold ETFs. I think last year there probably was a little bit something to that, but not going back prior, because obviously spot Bitcoin ETFs didn't exist until January last year. My point is, I can see a scenario where the Bitcoin ETFs have created some noise here, and maybe there's going to be a little bit of a battle playing out between those two categories, because Bitcoin is viewed by many advisors and investors as digital gold, right? So
being one of them.
So I think that's another wild card.
You viewing it as digital gold, because we are going to talk about Bitcoin in just a second. I feel like what happens with gold, though, is it kind of pops up every couple of months. There's like a new headline about the record prices of spot gold prices jumping. I remember when, gold had hit 2,500 and that was a huge story. And now we're literally spitting distance from 3,000. I hear people talking about when we're going to hit 4,000 in gold. But speaking of the Bitcoin story, because I'm curious to know if we have another ETF Game of Thrones on our hands in terms of Bitcoin ETFs and gold ETFs, or if people kind of view gold and Bitcoin as an and type of investment play instead of an either or investment play. I have a feeling it's an and sort of situation that we have going on. But speaking about Bitcoin, so we see Bitcoin prices falling, dropping below 90,000. The spot Bitcoin price right now, I was just checking it before you and I started chatting. It's roughly around 88,000. So we're obviously off of its highs. We were kind of touching 100,000 not too long ago. Bitcoin ETFs have had massive outflows. FBTC led the outflows of all the spot Bitcoin ETFs, a couple hundred million in outflows as we're seeing people essentially dumping out of the Bitcoin ETFs. So first things first that I sort of think of, because whenever I see Bitcoin prices fall, I get excited because I think finally I can buy more and I think I should be buying the dip. But there's some people that are saying this is not the time to be buying the dip in Bitcoin because there's a lot of concerns. One, Trump has not had the sort of boosting effect in terms of his policies on cryptocurrency that I think a lot of people were anticipating or expecting when he came into office. Two, there's a lot of concerns around the Fed and where inflation is going to be going in the future, and that Bitcoin is not necessarily the best asset to be holding at this time. Perhaps gold is. So I'm just curious to know your thoughts. Are you someone who is seeing this news of Bitcoin prices falling and getting excited as a buy opportunity, or are you looking at it as like there's something else going on here?
Well, I always have the buy the dip mentality across any asset class because I'm a long-term investor. Here's what I think. I think that Bitcoin right now, its track record is only about 16 years. And gold's track record is 5,000 plus years. And I like how you co-opted my term, the ETF Game of Thrones, and applied that to gold and Bitcoin ETFs. I actually think that's really interesting. I do think there's a battle there because Bitcoin, I believe, still has to prove itself in a variety of different market environments. And it's gone through some ups and downs. We had the COVID crash back in March of 2020. There have been other examples where there's been a lot of volatility in the markets, and Bitcoin's had to go through that. But there is a pretty vocal camp of investors who will tell you that Bitcoin is essentially just a technology play, or it's a risk-on asset, and it's going to move along with the triple Qs or the S&P 500. And there's some truth to that if you look at the historical charts. There is some correlation there. And so my point is that I think Bitcoin is going to need to perform well if and when we have a substantial market decline. So let's just say things fall off a cliff, economy slows down, we know stocks are valued on the high side, and let's say the S&P 500 is down 30%. I hope we don't see that, but it's possible. I think Bitcoin needs to perform well in that environment. Whereas gold has a track record. It's not always going to be up in that situation, but gold has a good track record of being an uncorrelated asset in a portfolio. And so advisors can have comfortability that it's going to offer some diversification benefits over the long run. Now, there's also a lot of debate around gold, right? You have a very vocal camp that says gold doesn't produce anything. There's no dividends. There's no interest. It just sits there. You have to have somebody buy it at a higher price. There's some truth to that. But I think about gold in terms of the correlation benefits that it adds to a portfolio. Can it help with the risk-adjusted returns? I think Bitcoin just needs to prove that over a longer period of time. And let me just say, and I'll pause, there is data out there that shows Bitcoin is additive to a portfolio in terms of its risk-adjusted returns if you position size it properly. So let's say you own between 1% and 5%. There is that data. I just think investors want to see this play out on a longer time scale.
Yeah. I mean, I still think some people don't even fully understand Bitcoin or Ethereum or any of the other cryptocurrencies, and they're just doing it because FOMO. They just...
Well, and that's something else I think is interesting here. If you look this year, Bitcoin is only down about 5% year to date. If you go back to the beginning of last year, right around when the spot Bitcoin ETFs launched, Bitcoin is still up 90%. So I'm kind of like, what are we doing here? Are we really that up in arms? This thing's up over 90% over the past 14 months or so.
Yeah.
So I'm sorry, you're going to get pullbacks now and then. There's no free lunch. I know it's cliche, but no risk, no return.
Right. Is this a false breakdown, do you think, that what we're seeing then in these Bitcoin prices lately? Because I mean, there's some people that said that, because we fell between this level of 89,000 and that some of these prices that we're seeing in Bitcoin means that honestly, it's a sell signal. But to your point, I just pulled up IBIT. 1 year, 84.91% performance. So let's just call that 85%. Obviously, massively beating pretty much most other, I think, investments that you could have made at the same time. I don't know of too many other ETFs that are beating 85% in 1 year. There's a few, but not many. And definitely not if you just did broad market. You're obviously massively going to still be beating. Now, year to date, we're only up about 2%. And in the last month, we're actually down over 8%. So, I mean, to your point, yeah, but I think isn't that the problem with Bitcoin in general? That you get these, if you pull up a chart for Bitcoin, it's like a precipitous climb upward and then a massive drop, the Tower of Terror at Universal, or is it Disney? But that's what it feels like sometimes. I don't feel like this being a Bitcoin investor is for the weak. You have to be willing to dig in for some of these wild rides and swings that you're going to be seeing.
I think it was Bloomberg's Eric Balchunas who described Bitcoin as gold as a teenager, right? Extremely volatile, all over the place. You can't quite understand it. I think that's actually a perfect analogy. And, I'm not big into trying to read the short-term tea leaves. I'm always out there saying nobody knows anything. I think there are too many variables here. I just come back to the fact that Bitcoin is still young. It's a younger version of gold at this point, in my opinion. And so it's not going to act like gold. And that's my point earlier. I think it needs to develop that track record to give investors more confidence that it can be that store of value in a portfolio. It can be that inflation hedge. It can be that geopolitical crisis hedge. I believe that it will get there, but we're still in the early days.
Well, speaking about Bitcoin, because we're going to keep the conversation on Bitcoin, but you can buy Bitcoin and gold inside of an ETF. And now you'll be able to buy both Bitcoin and Ethereum. You'll be able to buy both inside of an ETF, which is actually interesting to me. I in a way like that. I just like I liked the Bitcoin and gold ETF, whose ticker name now escapes me. But are you excited about Bitcoin and Ethereum mashed into one ETF? Or are you no, I want to buy them separately?
I think there's value here. So there were two ETFs that launched in the past week or so. One was from Hashdex, the other was from Franklin Templeton. I believe Bitwise has a product that's rolling out any day now if it's not already out on the market. I think advisors in particular love the idea of diversification, and especially in an emerging asset class such as crypto. Because to what you were describing earlier, this can be a hard area to understand. People can't very easily get their head around everything that's happening in the crypto sphere. But if you believe there's something here and you have confidence there's going to be value longer term, I think spreading your bets among a variety of crypto assets or digital assets can make sense. And what's interesting about these ETFs is that right now they'll only own Bitcoin and Ether, but as the regulatory environment evolves, which we know it's evolving pretty swiftly, these ETFs will have the ability to hold additional digital assets. And I've said from basically day one, that's the end game here. You're going to see index-based crypto ETFs. You're going to see actively managed crypto-based ETFs. And think about on the equity side or on the bond side, that's where investors like to allocate, right? They like to spread their bets around and not put all their eggs in one basket. So I think there's value here for sure. Are they going to see the type of demand that we saw from spot Bitcoin ETFs alone? No, I don't think so. But I think there's going to be an audience here. I've heard some people compare this to the gold ETF category versus a broad commodity ETFs. And if you look at those two categories, there's significantly more assets in the physical gold ETFs. But broad commodity ETFs have done very well. If you look at products like PDBC or DBC, and there are others out there, I think that's what we're looking at on the digital asset side. So I like these. I think it's a easy button way to get at least some diversification to digital assets.
Okay, yes, but I guess devil's advocate, because when we do see diversification in, let's just call it equities, right? Or even what for like the gold and the Bitcoin ETF, you already know that if Bitcoin, not always, but typically the gold prices can sometimes mitigate the downside risk that you're going to see in some of the volatility that you already have in Bitcoin. But Bitcoin and Ethereum, not always, but a lot of times what we see happen in Bitcoin, we do see knock-on effects with other cryptocurrencies. When Bitcoin is down, Ethereum tends to also be down, and I don't think that we have, as you're mentioning, there's this kind of immaturity that exists in cryptocurrency. There's this immaturity that exists in Bitcoin and Ethereum and Solana. Now we've got XRP. Doesn't it feel as if buying an ETF that's holding both is just really doubling your trouble when you have it?
Yeah, I wouldn't consider it doubling your trouble, but I think your point is well taken. And that if you were to chart these digital assets, there's clearly a high correlation in how they perform over time. So I think that's a fair point. If I were to counter what you were saying, it would be that Bitcoin and Ethereum are two completely different things. I view Bitcoin, as we talked about earlier, much more like digital gold, whereas Ether, I view much more as a technology play. Now, that opens up a can of worms where somebody will go, okay, well, should we be mixing these two things that are completely different? Right. But that's where I go back to the diversification. And I think as you add other digital assets, whether it be Solana or XRP, those have some similar characteristics, but there are some unique attributes of those assets as well. And I think there's value to that. But yeah, it's tough for me to argue with your point if we were to look at how these things have performed, over the past 5 to 10 years. I think that's fair, but it goes back to my broader point overall in that I think Bitcoin in particular, it needs to prove itself when we have a very tumultuous market environment.
We'll see if Bitcoin can. All right, moving on from Bitcoin, we've got Fidelity. So Fidelity, just as context for everyone, has gone and has unveiled new ETF model portfolios, essentially all ETF, model portfolios. They've got 2 of them that they've launched. So this is obviously going to be something that a lot of advisors can take advantage of, wealth managers can take advantage of. They have some with goals that are from capital preservation to very aggressive growth. But you're an advisor. When you see news like this, is this something that makes you excited? How do you think that other advisors can sort of utilize some of these all ETF portfolios? It seems like they've just jumped on the Nate Geraci bandwagon because you've been doing this for a long time.
Well, there's some nuance here. So the question is, are you using somebody else's ETF model portfolios or are you developing your own ETF model portfolios? And I think there are pros and cons to both. So let's take what Fidelity is doing, which this isn't new. There are other large asset managers who they've crafted their own model portfolios because this can be an excellent distribution channel for their ETFs. Clearly, here's the thing. As I think about investment advisors overall, not every advisor should be an investment manager, right? Those are two very different things. You have some advisors who their skill set is really in developing and fostering and managing their client relationships, helping them with financial planning, guiding them along that full financial journey. There are other advisors that are maybe much more suited to be managing money. Maybe they're CFAs, and it's something that they have experience doing. And then there's a spectrum here. We have advisors, who are in between, who maybe have a little bit of both. My point is that, end clients ultimately view their advisor as being responsible for the performance of their investments. And you can make the case, in my opinion, that if you're outsourcing that responsibility, so I'm an advisor, I'm outsourcing that responsibility to Fidelity, the client may go, well, what am I hiring you for?
Right.
I'm hiring you to manage my money. And, as an advisor, I'll speak directly to this. Clients expect us to be able to explain why we own what we do in a portfolio and the rationale for the allocations. And it's not that you can't get those things if you're outsourcing your investment management to somebody like Fidelity, but I don't know that you're going to have the same level of diligence and knowledge as if you're managing those portfolios on your own. I'm not saying that's a good or bad thing. I just think there's a trade-off there. The benefit of using ETF model portfolios from somebody like Fidelity is that you can then, as an advisor, spend much more time on the other aspects of your business. Again, the client relationship side and marketing and all the other things that maybe you're better at. So I think there are pros and cons here. I think it comes down to the type of advisor and what their personality makeup looks like and just how they view the world in terms of managing a practice overall.
I'll let you have the last word on that, since you know the advisor world much better than I do. I'm always curious to know if retail investors, though, like to use these model portfolios as like a jumping off point for themselves. If they know they're not going to have an advisor at all, if they try to like DIY it themselves and get this info.
Yeah, and there are platforms out there that will allow retail investors to obtain these types of portfolios, and I think that's a great option for advisors who are comfortable managing that. If you have if you have an investor who they're disciplined, they're going to stick with the allocations, they're not going to alter them based on what's going on in the markets, and they can stay disciplined longer term. There's some value there, assuming they don't have other financial planning needs.
And by the way, going back to what we talked about last week, I bought a bunch of ETFs yesterday because it was my mid-month time for allocation. And I remembered I needed to do it. And I did it at like 10 o'clock at night. So take that.
That goes back, by the way, for some context. We had a conversation last week about Schwab rolling out 24/5 trading and how Kristin's coming home from the bar at 3 a.m.
I'm buying ETFs. And you
to buy IBIT.
Yeah, I thought about you. I was like, I'm going to have to let Nate know that I'm doing this at night when I think about it. But that's all for this week's episode of ETF Pulse. Please make sure, again, to send us comments. Let us know how you feel. Send us a note in the inboxes. You could tweet at us. And also, again, make sure to like, subscribe, follow this podcast. You can see me and Nate's beautiful faces every single week arguing with each other about all things ETFs every Wednesday.